Yes, sir. Back with JC Parets. We're doing this live. This is your first time doing this live with me, right?
It is.
All right.
It is. What a pleasure.
Badnick's able to do it, so I'm pretty sure you could do it. So, who's in the house today? Got Christian Fahy, Greg Sorensen, G. Markey. What's happening, kid? Rob Pruzan, Steve Lippold. A lot of regulars. Some new people too. We're gonna do an all-new episode of the Untitled Chart Show. JC brings us the best charts, the most important stuff that he's following for the month of April. And I know it's been a minute since we did the last one, so I'm really excited about this. How's your spring been so far? All good?
Dude, I like having spring again. It's nice. Back in California, it was kind of like, just always nice. So, mixing it up a little. Yeah,
I saw the Easter pictures. You guys are doing it right. You're hitting every note. It's like a catalog. I'm very proud of you.
Listen, good ham, some nice Pinot Noir to go with it. What's wrong with that?
Right. You hide the eggs? You find any eggs?
The eggs were like right in the middle of the lawn. Like she couldn't miss it. She's only 8 months old, so we got to make it easy on her.
We can't make it that challenging. All right, let's get into your first chart of the day. Duncan is on the ones and twos, adding in our charts as we go. So we'll prompt him when we're ready to go next. What are we looking at?
I mean, listen, this has been the biggest story since Labor Day last year is the just crazy, I mean, not crazy, but just a sheer outperformance out of the value stocks and just the underperformance out of growth, particularly U.S. large cap growth. That home country bias for the United States and investors here certainly served them well over the last decade. The more irresponsibly exposed that American investors were to high growth stocks, the better they did. They were rewarded for that sort of behavior, while those around the world with less growth exposure or virtually no tech growth exposure around the world, those with home country bias in those countries, like let's say Canada, for example, they were penalized for that home country bias. And that's been changing now.
Yeah. So it was a really, really big mean reversion. Value stocks, mostly cyclical value stocks, just went absolutely crazy. And now, though, what's interesting to me is that growth stocks have had a really good week. So they're actually like helping the overall averages make new highs. I mean, isn't that people are like, well, everything can't keep going up all at the same time. It can for a long time, though, right?
Yeah, no doubt. I want to take you back old school, 04, 05, 06. Early on in my career, interest rates were rising. Value stocks in that environment were outperforming growth as they have been in this rising rate environment, right? And but remember, growth stocks and tech stocks did well in that environment. The stock market did well. It's just that they didn't do as well as the banks and the energies and the industrials and emerging markets, right? This is that market. Growth stocks and tech can do well. In fact, Krinsky, our boy, he's put out a note maybe a week or two ago, and he said it can't, for the market to advance, it can't be growth or value. It needs to be growth and value. And I thought that was really well said, and we've seen some of that.
Not on a daily basis, but like that rotation should be continual, not once, but like week to week. There should be different groups that pick up the baton and do the job.
Yeah, and it's an international thing, right? So a lot of people really just simplify it, ourselves included, where we look at an IWF versus IWD, right? Russell growth versus Russell value. But it's global, and we're going to get into that in a minute. There's a lot of countries around the world that simply don't have that large cap tech and growth exposure that the U.S. has, and those countries have been doing very well.
All right, let's advance. Let's go next. What do we got?
So this one, I got to tell you, this probably has the biggest implications of any chart on our radar right now. This is the copper gold ratio. Obviously, it has a very, very high positive correlation with interest rates. Not to mention, so think about the implications there for financials. If copper's outperforming gold, what does that say about sort of that growth story? So the resolution here.
Can we back up so I can make sure everybody understands what this is? The black line is the yield on a 10-year treasury. And as you can see, that took off in July and has not really looked back. At the same time, the ratio of copper versus gold. So that's one price divided into another price, which shows you that that correlation is sick. I mean, I understand the economic underpinnings of why that would be correlated, but this is a really good chart.
Yeah, I mean, listen, it's been correlated for a long time. In fact, it was copper gold that was telling us that interest rates were going to go up, and they weren't. And it's like, why aren't interest rates going up? And then all of a sudden, woo, because when rates go, they go a little bit, and then they really go. And that copper gold ratio was pointing to that. And then ultimately rates ripped. And that's when growth stocks completely fell apart, because value stocks tend to outperform in a rising rate environment. So that's another implication of the resolution here. So, you know, for me, this has been a messy market. Small caps below the February highs. Emerging markets are a mess. There are a lot of messy charts out there. I look through 5,000 a week. Trust me. The theme is messy charts. Short term, of course, tactically speaking. So the resolution out of this chart is going to indicate to me whether this market is going to be messy for longer or whether that mess is mostly behind us. And I think this chart's going to tell us.
So one more thing on this. I think it's worth pointing out. Copper is not like Bitcoin, where it's all speculators. Copper has commercials in that market. Like, there are people that need to either buy or hedge exposure to commodity in that to the commodity, the actual hard commodity in that market. Like, that's not a video game market, copper.
Right. It's not a video game market at all.
Right.
You know, there's, of course, I mean, if you're going to build anything, I mean, I don't want to get too fundamental. It's not my area of expertise, but my understanding is if you want to build anything, you need copper. So copper is just really a great sign of demand and growth around the world. And gold is the opposite of that. So that's why interest rates most likely trade tick for tick with it.
Got it. All right, let's go next.
All right, now let's stick with this commodities theme, this value theme. Energy is a big part of it. Part of the reason why U.S. passive investors, for the most part, have underperformed so dramatically is that they don't own any energy, right? And some of these other countries, like Canada, for example, and Australia, and some of these other areas with a lot more energy exposure, have really outperformed. So I want to take you back to the low of 2016. That was also the low in energy a couple of years ago. And that,
I don't want to go back there. Must we?
Listen, those were good times. What are you talking about? That bottom in 2016, that was killer, man. Even the gold bugs made money off that bottom.
True, that's true.
Everybody getting paid. So one thing you learn on the second day of technical analysis kindergarten is that former support turns into resistance, or usually does, right? That's, you know, we call it the polarity principle, that you know, the former support turning into resistance. And that's exactly what's taking place here, right? Those former lows in the XLE, which is the energy sector, right? Those are stocks, are running into those former lows. And at the same time, if you look at the chart above, crude oil keeps bumping up against this 66 level. So if you ask me, JC, this messy market, how long is it going to last? Well, as long as the XLE is below those 2016 lows, it's a mess. As long as crude oil is below 66, it's a mess. So this points to the messy for longer. Look for breakouts in both of these to signal that risk is back on, that this market, for the most part, is no longer a mess, and now we can resume higher as a group collectively.
Just generally speaking, what's the psychology behind why former levels of support turn into resistance after a breakdown?
There's market memory there, right? There's a lot of shares that exchange hands. So, you know, I mean, listen, we could do a whole show about it, but anybody who was buying at that level, that made money off that level, is more inclined to buy it again because they were successful last time they did that. Anybody who shorted at those levels, when they get back to those levels, they're now at break even. Like, there's a lot of psychological implications for all participants at that level. The bottom line is there's a lot of market memory. So there's a lot of people doing a lot of different things for a lot of different reasons at those levels.
Yeah, I think that's a really important point, just like a good general principle to understand. When you talk about market memory, that's not like witchcraft. That's people where they're anchored to that price. It's meaningful to them, so they act in a certain way, or they can be counted on to act in a certain way. And then when they deviate from what you would expect, that's where the magic is.
Right.
That's when you know sentiment around a name or a sector or a commodity or whatever has meaningfully changed. When buyers don't show up where you thought they would, or when sellers don't show up at key levels. I think that's really important. Duncan, let's hit the next one.
All right, so this is one that we've been watching. Yeah, I figured you would. We've been watching this Europe. Look at the Euro Stock 600. I've been waiting for that breakout since I was in high school, to be sure, right? We are now, for the first time since JC was in high school, over 20 years ago, breaking out of that base. And it's hard to ignore. We're breaking out to new all-time highs in Europe for the first time in multiple decades. So this is a very easy way for anybody to get involved. You could be trading your first Bitcoin, or you could be a 40-year veteran financial advisor. This is a vehicle that can serve all kinds of investors. And I don't know if you can see there on the bottom right, but I wanted to include the components because Europe looks a hell of a lot different than the United States.
Yeah, we see it great. This market is 30% extremely cyclical. Industrials and financials are really important in European stock markets. And everyone knows those names. These are not little companies. These are massive companies and I think that's what has led to so much U.S. outperformance. Obviously, the U.S. economy has been rebounding faster than the European economy this past year. But the sectors that Europe has a lot of are the sectors that are on fire worldwide. So this makes perfect sense to me that it's breaking out here.
And the lack of exposure to the sectors that are not doing well, just as importantly.
Correct. Like there aren't like $500 billion market cap work from home companies in Europe. It's just not what they have. However, I want to point out this area has been problematic for Europe bulls in the past. It's two really nasty false breakouts, I guess, or a double top, or however you want to think about it. Why do you think this time might be different?
Because the market's proving that it is, right? We are actually now breaking through these levels. And I do a lot of math when it comes to the 61.8% retracement. Again, it's not a coincidence that these double tops or these resistance levels that you speak of showed up at those levels. Again, there's market memory there. And now the market has proven that the demand has finally been able to absorb that supply. Because the more times that it knocks on the door, the more demand that is there absorbing that supply, to the point where eventually, when demand has finished absorbing that and prices can now move on, that is the market signaling to us that where there were more sellers than buyers, where there was an overwhelming amount of supply relative to demand, is now the opposite, right? Now the buyers are in control. Now you made a great point. What if this is another failed breakout? It certainly can be. I have no idea. But the level is $60. As long as we're above $60, it's been a great trade. I mean, not great, but it's working so far a little bit. $60 is the level. If we're not above 60, all bets are off.
Do we have to retest?
No, absolutely not. In fact,
no need.
A lot of traders are always waiting for that retest. The best breakouts of all time don't retest. So if you're always waiting for the retest, you're by definition going to miss the greatest trades ever.
Okay. So this is continental Europe, VGK. There's no England in here, which is
there is. It's actually 23% United Kingdom.
Oh, it is? So which one doesn't have England in it?
But I will tell you this, it's super diversified. The biggest holding is Nestle, and it's less than 3%. So you really don't have, it's not like this FANG-driven index. It's very diversified.
Okay. And then like all the automobile manufacturers in Germany are in here, and the big healthcare names in France, and it's got
Novartis, AstraZeneca,
Yep. And energy has shrunk as a percentage of this, but historically, there's been a lot of big energy companies in here. I don't know if a big energy company even exists on Earth anymore, but those could grow within the context of this too over time.
It's more exposure than the United States has.
Yeah,
Royal Dutch Shell's in there, right?
Right, Total. It's amazing, but that's the case. Okay, let's go next.
All right, so listen, we me, I like to talk about bonds all the time, even though we're not having a bond conversation. For me, I'm very intermarket oriented. But at the end of the day, what's the damn trade, JC? Right? Give us a trade. So I'm going to give you guys a trade. Every other Monday, we come up with the Under the Hood report. This is just a list of stocks that are showing an unusual increase in investor interest for whatever reason. It might be a ton of insider buying, huge volume coming in, a spike in social media mentions, unusual options activity. There's a bunch of stuff that catch our attention, that get these stocks on our radar. We build a universe, and all the universe is
how many signals are you pulling in to build this universe?
more every day, like a zillion. And, you know, I'm working with Andy Swan at like Folio, getting more data, and I'm working with Koifin and StockTwits. I mean, we have more data than we have people to dive into. I mean, it's out of control, the data set. We're getting new computers. We're building freaking supercomputers because the data keeps crashing our shit. Like it's it's pretty funny actually, but good problems for sure. Needless to say, we build this universe. What I like about this scan is that it's long and short, right? Because just because a whole bunch of lunatics are paying attention to a stock doesn't mean we want to buy it. We might feed the ducks and fade them, right? So it's a long and short scan, which I really like. And then of these 60 stocks, maybe only a handful actually are actionable at best, right? So all we're doing is building that universe, and this is it, right? There's nothing fancy about it.
Why 60?
There's no rhyme or reason. It could be 100, it could be 50. 60,
so you have to, but you're gonna comb through all 60 of these names individually. So you're gonna say like, all right, this is the universe, but now let's use our eyes and see what we can really see.
This is the science, this is the robot, and then the humans step in.
Okay, so that's where it goes from being a science to a science and then an art on top of it.
Well, what was that chess tournament that you can either be a human, you could be a computer, or you could be a human with a computer, and the human with the computer was always doing the best?
Yeah, that makes sense to me. Okay,
yeah.
So now you put your eyes on these 60 names, and what do you find?
Well, you find usually a whole lot of nothing, just a bunch of mess. You know, people are paying attention to it for reasons that we don't really care about. Duncan, if you want to switch over to the next slide, this is one that caught my attention. This is United Therapeutics. It's a mid-cap biotech, UTHR. And, you know, to get back to your earlier point about when markets don't react to resistance levels or support levels that theoretically they should, that's the signal. Well, that's exactly what's happening here. That former resistance from 2015, the market gapped above that. So we call that a gap and go, a breakaway gap. It's got all sorts of silly names, but it ain't a bearish.
This thing just got a second FDA approval for a pulmonary hypertension drug, and then this morning JP Morgan raised its price target before the open by like 10%. So
yeah, because they're getting the under the hood report that JP Morgan analysts right there. You know what I'm saying?
They're front running your under the hood. All right, so I love these types of charts because I understand this concept of like a multi-year consolidation and a lot of weak bulls coming out and the sellers finishing up what they're done selling, and then a gap would be really exciting here. Maybe today's upgrade would be the thing that makes it gap. I don't know.
So two things, positive momentum, and I want to point out the relative strength down below. We're looking at UTHR relative to the rest of the market, also breaking out of a base, right? There's wisdom in relative strength. It's evidence of institutional accumulation, and that's the kind of stock that we want to be long, right? Having big institutional money behind us, not against us. And the best part of all of this, as usual, is that the risk versus reward is very much skewed in our favor, right? Because if the stock is not above 190, then we cannot make the argument that we're breaking out of this half-decade long base. We can't. So we can only make that argument if we're above $190. So that's the risk. And then the upside is 70 points towards 260. So the risk reward, I mean, that's what it all boils down to at the end of the day.
So relative strength, you're basically ranking this stock versus how the Russell 3000 ETF is doing. And it's starting to, I guess it's since early 2020, it's been in an uptrend relative to the overall market, but now it seems to be inflecting out of a range. So
totally.
All right, cool. So we're going to keep an eye on this. We're going to come back first week of May. We'll do the most important charts for May of 2021 the next time we're here. JC, where can people go so they can learn more about your various solutions and services for traders? What's the best place?
No doubt about it. Listen, I'm easy to find at All Star Charts on Twitter, Instagram, StockTwits, YouTube, and Clubhouse. And if you're interested in our quarterly playbook, we're dropping this quarterly playbook today, as a matter of fact. So if you email candles@allstarcharts.com, we're going to send you a sample of that quarterly playbook. Candles@allstarcharts.com, password playbook.
All right, we're going to throw that in the notes so that if people aren't watching this live, they'll know where to go. All right, we appreciate you. How'd you like doing this live? It's fun, right?
Dude, I mean, listen, you and I, we've been doing this for a long, long time.
Yeah.
I'm looking at these charts anyway. I'm talking about them. Happy to do it.
I was going to say, you and I would do this if there were no cameras.
Right. We do that with no cameras. That's
what's
why we
the
brought the
difference?
cameras.
Yeah. Hey, guys, thanks for joining us. We appreciate it. Check out allstarcharts.com for more from my man JC. Make sure you're subscribed to the channel. Give this video a like. The algorithms are very, very interested in likes. So feed the algos, and we will see you in May.
Adios.